We have some questions wanted to go over with you to kind of, share your experience, learnings, and just any advice you have for the audience members, product execs, angels in the group. Many of our, audience members are seasoned product leaders looking for ways to jump into angel investing and VC. What do you think is the role of angels in the venture and tech ecosystem?
Well, there's a whole capital stack in private companies, and maybe I'm stating the obvious, but angels are really there at the beginning. They're there to believe in something that I think maybe a professional investor who has sort of a consistent set of things they look for, and sort of established set of frameworks might miss, because either it's not the stage they focus on, or they would ordinarily need to see something proven that just isn't possible that early.
Mm-hmm.
I often find that everyone who's an angel needs to have a particular business model that works for them, and it doesn't need to be the same thing for everyone. Some people are just investing in their networks with really no other filter than, this is someone I really think highly of.
Mm-hmm.
Others are thematically focused. They have a state of the world they believe in, and then they're backing companies that are on that vision. And a lot of the times that's informed by your day job. You might be working inside of a fintech company, maybe Stripe, I don't know. So you see what people are doing, what needs exist in the payments infrastructure stack, and you're going and finding those companies to invest in. Or you are seeing your friends leaving Stripe and you're backing them. So there's a combination of both. So angels play this interesting role where because they have unfair insight into the capabilities of individuals, or they have a unfair insight into how the world is changing, they can be first to things that are going to be big. So that's the role I see them, playing, even in a world where, Lightspeed makes seed investments. We invest really early, but even so, there's going to be things that we're not going to see, or because necessarily we didn't know that person, or it was not a theme that we were studying intently.
So have you leveraged angels to be in a way trend forecasters, people who are kind of first in to see deals that then bring them to light speed? How do you collaborate or work with angels in your kind of day-to-day investing at the firm?
Yeah, well, we try to be thoughtful with regards to who we spend our time with in general.
Mm-hmm.
And we like to be able to, even if we don't invest in a company, at least deliver some insight into why we're not investing, or give some sort of context into other things that we've seen. So the relationship that we have with angels is often they will bring us deal flow. They love, obviously, to get the markups from a good firm, but more importantly, they're often looking for feedback. And so we're sort of the aggregate of our network, and so the more people that show us stuff, the more sort of intelligence we have over the entire ecosystem. And so it's a collaborative thing. Hopefully, if angels work with us, they're getting better because they understand what's going on, and then we're obviously benefiting because we're seeing interesting companies. So we do depend upon an ecosystem
Mm-hmm.
to sort of feed stuff up to us as one of the larger firms to take things from there. And often, but the other option is we'll often collaborate. So we'll invest alongside some of these folks. And I guess the third thing is we will invite some angels into our rounds. I had a company that I seeded at Lightspeed last year that just raised a Series A, and in both of those rounds, the CEO was asking us, who can I invite into this round? I want to diversify my cap table. I want to add some different perspectives, some people with different backgrounds, different skill sets that I need. Who should I invite into the round? And so it goes both ways. It's a bi-directional kind of thing.
Yeah, I love that. So for the operators out there who are trying to get started in angel investing, what do you recommend as, good first steps, ways to kind of warm your network and relationships with founders for deal flow? How do you kind of like signal out there that you're ready to start angel investing?
Sure. Well, I'll sort of caveat this with I am not an angel investor. I don't know. I don't know if I'd be a good one. So when Bo first asked me to do this, I told her I had to say that because I think being a professional investor, and I've only been a professional investor my whole career, is very different than being an angel
Mhm.
in a lot of ways. Like I take extremely concentrated positions in one or two companies a year, right? Like
Yeah.
that's like the opposite of angel investing. So I need to be really, really confident in a company when I invest in it because I'm not going to get that many shots on goal.
Mhm.
Whereas angels can make 20, 30, 40 investments and have a couple work out. And as long as one of them is like, Twilio or Instagram, like you're good. So, so all that said, um, how you think about starting, I always, anyone who wants to get into investing in private companies, I tell them the same thing, which is to think about what makes you special. Think about what your affinity networks are that you belong to, and try your best to double down on those. Everyone's looking for an edge, right? Everyone's looking for some sort of thing that they know about deeply that others don't.
Mhm.
They're looking for a network they have unfair access to. So think about like if I'm going to be an angel, what's my unfair advantage? What's my right to win versus someone else? That could be like what school you went to. It could be somewhere you worked. It could be you know I have a partner who's British. When she started at Lightspeed, I said to her, you know, how many British founders are there in the Bay Area? Like there's probably not that many. Like you could probably meet every single British founder in the Bay Area, and you should all invest in each other's companies. Like that, like it's almost as simple as that. Sometimes when you have these affinity networks you belong to, you have unfair access. Like I couldn't get access to that network as easily as she could.
Mhm.
So that's the place I would start. Um, I think there's a strategy where you sort of team up with other angels. So I know angels who like to invest together. So my partner Jana, before she joined Lightspeed, started something called #Angels, which was like one of the first like West Coast angel investing cooperatives a few years ago. They all came out of Twitter together, um, and they've invested together in I think over 100 companies, and they will each of them is sourcing out there, and when they find one they share it with the others, and they'll often be able to get into stuff together because they all have different skill sets. So you say, well, you should take money from me because I can get Jess really into this, or I can get Katie Stanton into this because you need Katie's skill set. So they're like kind of like a small partnership in a way, like a sum of parts. And
Mhm.
that collaborative approach can work for angel investing where you're not really competing, but you're trying to all get into the same deal. So that's another way to do it, sort of sum is greater than the parts model. Um, I think those are the two things mainly.
Yeah, I mean, with #angels, it's incredible how fast they're able to operate as well. Like they are sending each other deal flow on a weekly basis and making decisions not just as a group but also as people who are interested in terms of expertise and can be a deal lead. So there is a
Yeah.
really compelling like operationalized aspect to them as well as just like you get diversified social capital from this group of angels.
There's a lot of trust though. Like
Mhm.
I've seen how they operate like up close now that I've worked with Jana for so long. And
Yeah.
like um they there there's so much trust, and there's real candor, right? So it's like, I don't think this is interesting. Like, I don't think you should invest in this. Well, I'm going to invest in it anyway. Okay, fine. I'm not doing it. You can go do it. Or it's like, like, or it's like, well, I've known this person for a long time. I'm going to invest. Okay, I trust your opinion. I'll invest behind you. So you need to have that. You need to actually be really tight. I think it's hard to like do that if you just picked like 3 people on AngelList to go co-invest with because you thought you had relatively complementary skill sets. It may not work because you don't have, they all work together and have like that shared bond. So there's other groups, by the way. I mean, Airbnb has like an Airbnb Angels group that does this. There's
And I
like,
think some of their alumni like started a fund too out of it.
yeah, I don't know exactly the structure, but I know there's a group of Airbnb alums that invest together. I think there's a group of Uber alums that invest together. So it's a popular strategy. I think the one thing you have to do though, you have to avoid groupthink with that kind of situation
Yeah.
because you know it turns out like the best opportunities are not well understood early on, and so the larger the group is, the more it trends towards the conventional wisdom. Let's just say, right?
Hmm.
So if you keep adding people to the group, definitionally, like more people are going to have the median viewpoint. And so there'll always be someone who's going to like, oh, that'll never work. And then once you get that into the fray, it's kind of poisonous. So um, you can't make these things too large, or I think they start to like be less effective. That's why I think hashtag Angels is like a great. Um, it's such a great like example because it was at the time there were not that many women investing in early stage startups as angels, and they all came out together at the same time. They made this very bold statement about it. They branded it. Like there were groups, but they weren't like branded. They like branded it. They used the hashtag so everyone knew it was because they were at Twitter together. They had this high trust factor together. Like it was just it was really well executed what they did. And so I'm hoping to see more of that from different networks and different types of companies.
Are there any upsides or downsides to investing as a group, say like doing a syndicate deal or SPV versus writing individual checks from your perspective, as an institutional investor leading the round? Are there variables that, as an angel, you should consider positioning yourself to founders?
Well, I mean, are you asking sort of structurally like SPV versus your own capital? That's
Yeah. Yep.
I mean, SPVs have a lot of administrative overhead and involve raising money from other people usually. So it just creates more work. Um, it's maybe helpful if you want to accumulate more capital to invest and earn carry off of it. But if it's just going to be your money and your friend's money, then it's probably simpler just to do it off your own balance sheet. Um, the SPV is only helpful if you're raising money from other people and you're raising money from a large number of people.
Got it. And you mentioned like as an institutional investor, you're doing just a couple of deals a year. So it's like a very high degree of diligence and discipline. Whereas as an angel, you're able to invest more on personal convictions. I'm wondering if from the types of things I've learned from you, like writing a memo, for example, like there are still ways you can apply in an institutional investors level of rigor and analysis to angel investing. What are some of
Yeah.
the say frameworks or attributes or kind of traits you're looking for as an institutional investor who you think would also benefit angels too to kind of
Yeah.
make the better bets?
I think that if you're going to get into investing of any kind, this could be like investing in public markets. It could be investing in real estate. It could be investing in venture capital and angel stuff. Like you need to have some sort of rubric because any given deal may or may not work out. The thing you have to have faith in is that your process is going to work. So you have to be able to do something day in, day out. And over time, your batting average is like high enough that it works. And so consistency is like the name of the game. So now what the framework is, I don't want to be too prescriptive about it. People can come up with different things that work for them depending on what their edge is or what their insights are. My friend Nikhil Trivedi, who just he was at Shasta for a long time, and he wrote this solo capitalist. Yeah, he wrote this post about, he coined this term solo capitalist, these like solo GPs. So he's going around doing his own investments now, and he started to do these. I think he calls them screenshot memos, where he will write like a one pager essentially on the deal that he's doing, and it's something to the effect of like, why is this company special? Well, what do they do? Why is it special? And why me?
Mm-hmm.
Basically. And he has a few pre-built frameworks for establishing why a company might be special. The types of things I look for are not going to be the types of things that all of you are going to look for in very early stage investments, but it's probably some combination of team, market, product, evidence of traction, and the sort of economics of the deal.
Mm-hmm.
Those are the basic elements. I also tend to think that having some sort of strategic lens that you look with a sector matters. Like, in marketplaces and commerce, network effects and economies of scale really matter a lot, like to predict success. It's not often the case that you start off going after a whole market, but you need a wedge into a market. You need a way to unlock liquidity. Like, that's really important. So you need to have a theory of how that's going to work. You need to have a team that's somewhat credible in executing that plan, and you need to have enough capital and time to be able to do it. So if I were to put a simple memo together, it would have to like have those things in it. But if I invested in like deep tech stuff, if I invested in like LiDAR systems and bioengineered plants, like, I would have a very different rubric, right? Like, if I invested in like bioengineered trees that like absorb more carbon and sell carbon offsets, like that's a company that is out
Yeah.
there. Well, maybe I say, well, look, there's some science that's been around for a long time, and it's really been successful in this field, but it's never been applied to this field. And the theory is that, like, if you apply it to this field, there's some really tangible technical milestones you can accomplish that are engineering, not science. And that over this period of time, they'll be able to hit those engineering milestones, and then they'll be able to raise more capital. And then once they raise more capital, they'll be able to hit this next engineering milestone. And then they'll file for some regulatory permit, and then they'll get it. And then, so you have to have some theory of how you build the business and how you're staging capital to risk in a business like that. But it's very different than the other types of businesses I invest in. So I'm just trying to give you guys like two very different.
You're not being very prescriptive here.
I don't want to be super prescriptive, because you like, one of you might say, I'm a great product thinker. Every time, like, I was the first 10 users on Twitter, Instagram, Snapchat, and like whatever. Like, I just have good product instincts. So my rubric is, it's a product that I love, that I use an hour a day at least. And if I'm using it an hour a day, I tend to be good at predicting what's going to be successful. That could be part of your rubric, right? But it needs to be something that you do consistently. Because if you don't do it consistently, you're just kind of spraying and praying. And then who knows if you're going to be successful? I mean, you still might be, but investment is about consistency and process. Because otherwise, you're not
consistency gives you more data points to be able to make benchmarks and reference off of the previous track record you're building, and also just seeing patterns and being able to have more of a gut check around the types of companies you're seeing.
Well, in venture, it's more that, like, if you're not consistent, you're going to revert to the mean. Like, because if you pick something that is contrarian, but you're kind of doing it over and over and over again, at some point you're going to be right. Whereas if you kind of just do every deal that seems interesting, all of a sudden now you have no advantage. There's no information arbitrage. There's no there's no reason you should win versus someone throwing darts at a wall. And if they're throwing darts in venture, they're going to lose, because it doesn't matter. Like, the average company is not that good. You don't want to be average.
So in terms of practicing that consistency, what do you do to make sure you're kind of applying a consistent level of rigor? Is it thesis development? Is it, assessing founders through, 5 different intangible traits? Like, what are ways for you to kind of practice that consistency over time? And when do you also just tell yourself, hey, this is not working, so it's time to come up with a new rubric?
Well, the way I like to think about it is I generally have a way I invest, and then and then I try to take it across different themes. So the way I invest usually is looking at trying to find a sort of a piece of data that gives me some insight into how the business is going to perform against a thesis that we believe in. And to try to be, hold on, my kids might be coming in. You're eating your apple. That's good. So I try to like be able to find a little bit of predictive data that will tell me where something's going to be in a couple of years. And then I really try to interrogate the data to the point where I have some sort of insight that maybe even, that certainly the market doesn't have, but maybe even be new news to the founder. And when I feel like I know something that others don't, that like is very positive about the business, that's when I get very excited and I lean in. So then it's all about, well, where do I have enough experience that I can have that kind of insight? Generally speaking, I focus on commerce because that's where the patterns tend to transfer from like business to business. But they also transfer a little bit in social networks and in media and that kind of stuff too, just not as directly. So I just try to find adjacencies as I build out my portfolio. Is I try to be like really excellent at like a couple different types of businesses, and then find adjacencies and kind of build out in concentric circles from there. The times when I've made mistakes as an investor have been when I found a shiny object and chased it, but it was not with my methodology or in my wheelhouse. And there's stuff I missed, or there's stuff I overlooked. Like there was some key problem that I kind of saw because it was obvious, but I didn't know how important that was going to be down the road.
So it's not just important to get into like a hot deal that other tier one firms are leading, but also you're saying couple that, like make sure there's conviction and some type of consistent, rubric or methodology expertise behind it too.
Yeah, maybe to be a little more specific.
Sure.
And I'm going to close my door. Just give me a second because my kids are going to run in here.
No problem.
We were going to have childcare today, and now we don't. So
welcome to 2020.
Welcome to 2020. So to give you a specific example, we do a lot of cohort analysis on our team, and we're constantly looking for is there a subset of the users who represent really strong product market fit? Because it's not usually all users. Like you usually have some people in the product who are occasionally buying or occasionally transacting. But then there's some set of users who are just like rabidly addicted to the service. And what is it about those users that makes them rabidly addicted? Could you change something in the product so that everyone would get that way? How do you go find more of those people? Like you're looking for these leading indicators. As you dig into the cohorts, there's some group of people for whom this really works well, and you can use that as a wedge to get into successively bigger portions of the market. With Daily Harvest, which is I'm on the board of, when I invested in the company, it was almost all smoothies. Today they do a lot of different things other than smoothies, but they found this really strong niche of people that like to drink smoothies after they worked out or for breakfast in the morning. But it was clear those people had other stuff they would also buy that was not smoothies. They were obviously eating other things. So
the smoothies unlocked the soups and the more savory food groups too.
Yeah, they had just launched. I can't remember if it was oatmeal or chia bowls. They had launched another SKU. It was also a breakfast thing, so same day part. but you saw that those people were also crossing over. And so you go, okay, this is not just a smoothie company. And the people that would try more than one um, meal type would spend more, like significantly more money than everyone else over time. And people who had bigger boxes would spend significantly more money over time. So like you knew that if you kind of got people into that echelon, if you somehow were able to get them from smoothie to like bigger box of smoothies to bigger box smoothies plus oatmeal, like you'd eventually be able to build sort of LTV, lifetime value, into the cohorts, and that would fund more growth, and then you'd be able to add more stuff. And so there was this virtuous cycle that was starting, and you could kind of see that if you looked at the data. So that's what I mean. Now that's what I do at my stage. It's harder to do that as an angel, right? But it's just an example of a way to look at the world. And it's consistent with every investment I make.
So why don't we open it up to the audience for Q&A? Any questions out there?
I have a question, if I could.
Yeah, go for it.
Hi, Alex. Thanks so much for your time. My name is Guto Araújo. I'm originally from Brazil, based in the US. My company is in Brazil. I'm an entrepreneur of a company. It's sort of like Etsy in Brazil, and I'm the head of product and technology. So I'm wondering, in your experience, you said you're not an angel, but I guess I'm sure you interact a lot with angels, and you know the good ones from the ones that are not adding a lot of value. Being a product person, the question I have is, what would be my biases that will make me a strong angel investor, and the ones that will derail me? So do you have that perception about, people that come from product, where do they get things right? They have an edge usually, and where do they fail miserably because of that same strength applied in a not perhaps disciplined way? Is there such a pattern that you see?
Yeah, it's an interesting question. There's kind of two failure modes when you come from an operating role into investing in general. One is you kind of overmatch the patterns from your own experience, right? So like you saw a lot of people do this that came out of Facebook and Twitter when they got into venture, where it's like, well, everything worked this way at these companies, so it should work this way at your company. Well, there's a lot of ways to do product. There's a lot of different types of product leaders. And just because you did something your way and it worked for you doesn't mean some other founder is going to be able to execute that in their company. And doesn't mean that like your opinion about their product is going to be right. And that sort of segues into the second failure mode, which is, being too prescriptive essentially with founders, which is a good way to not get them to take your money, like, or kind of piss them off during the relationship. And like, it's a tough balance to strike, right? Because you do have presumably a lot of experience that can be valuable to them during the sort of courtship process. You want to try to convince them that you can be a good thought partner to them on product because that's your background. But at the same time, what makes these people special is that they have these instincts and they have these insights that no one else really has. So trying to find ways to like be a good thought partner, but also know your role and like know when you can insert yourself and when you shouldn't insert yourself is one of the most challenging things about being a minority investor. When you're in private equity, when you own the business, it's a lot easier because you're the owner. So you can, if the CEO doesn't do what you want, you just fire the CEO and you bring a new CEO. That's what private equity firms do. Even in big venture firms, we don't own the company. We have one seat on the board, maybe, right? Out of 5 or 7 board seats. So it's not, and we never own half the company. So you're always trying to influence someone, and you have to do so from a place of where they can hear you. And if you come in and go, well, I did this thing this way, that means you should do it this way. It can be, most founders react allergically to that.
Great. Well, thank you. Makes a lot of sense.
Sure. I feel like do like the Bueller.
Bueller, yeah. Don't be shy, guys and ladies.
Well, I'll lob a question in. Hey, Alex. So actually, on the venture side, but I do angel investing around deals that my partners can't get behind, but I'm convicted, and I'll write the angel check. But for the group, I was wondering, like, what are your recommendations around building relationships with VCs? Because obviously, as our companies sort of progress and are looking to raise their a later seed or a Series A from an institutional, we want to be helpful with the introductions. And so, is it worth making the investment to get to know VCs, or how do you go about? How would you recommend going about that?
Well, it depends on what your value proposition is to the founder. Like some angel investors like will say, well, you should take my money because I know all the partners at Lightspeed, Sequoia, Excel, whatever. Like I know all these people, so I'll be able to introduce you for your Series A. Like, so that's the value prop you want to double down on. Then maybe it is valuable to spend a bunch of time with VCs. I don't know if that's a huge value prop nowadays because we're all pretty reachable. Like it was different back in like the 90s and the 80s where everyone was really on Sand Hill Road and like it was hard to get a meeting and you had to send a paper business plan in the mail and like that kind of thing. But that's not the world we live in now. We're all on Twitter, or we all put our email addresses on our websites, right? So, and most, contrary to what you would expect, most of us do read cold emails, even if we can't respond to all of them. So, I don't think that is as valuable as it used to be. The other good reason to spend time with venture investors is, as I sort of said at the beginning, like there's a little bit of a give and take that you're getting the benefit of their sort of larger aperture over the market. And there might be opportunities to work together on new stuff that's coming through. And I think most good investors try to build bi-directional relationships. They're not just taking. So, but that being said, like, it's not likely that a single meeting is going to lead to like something that is instantly actionable. These are long-term relationships.
I have a question. Hey, Alex, nice to meet you, and thanks for sharing your wisdom. I'm Julie. I'm at a fund called BetaWorks, and I also run a female angel group where I met Bo. You mentioned earlier you had learnings from certain failed deals where you chased the shiny objects, missed some obvious ones. I'd love to hear your thoughts on the reverse. So maybe you missed certain deals and you saw certain errors, but you missed certain opportunities. And those usually, for any investor, we always have that coulda, woulda, shoulda been my.
Yeah, I have a lot of those, unfortunately. This is being recorded, so I can't really, I don't want to get into too many specifics.
Sure.
Sort of like the name, I'll try to anonymize some of these. Geez, what can I? Oh, there was one I was thinking about recently. Okay. So sometimes what ends up happening to me is, I don't know why this happens to me, but there's been multiple occasions where there have been two companies that I liked a lot that were raising money the exact same week. And when you're doing the kind of diligence we do, it's really hard to parallel process two companies. It's not just the diligence, it's the relationship building. So like, you're trying to spend time with these founders, and there's just not enough time in the week. So I can think of two examples of times when I had to sort of pass on a company I thought was pretty good because there was a company I liked better, and I had to make a choice. In one of those instances, I think I made the right choice. In the other, I definitely made the wrong choice. The wrong choice one was instructive to me because the company I chose to spend time on was these I think they're two founders who were very, very like just very experienced operators from a well-known Silicon Valley company. They were very technical, and they had like an incredible technical solution to a very cool problem that, and in a market that I'd been writing about for a while. And so like, I felt like I had an unfair degree of knowledge in this category, and that their solution was like the perfect solution to the problem that I found. So it fell into all my confirmation bias traps. And then on the other hand, there was this other company that wasn't in the Bay Area. So I had to get on a plane to go visit the company. And it also wasn't in like one of the normal cities I go to because I travel a lot pre-COVID. But this was like in a city that none of us had ever done a deal in. So, and I had gone and I visited, I spent time there, and I thought it was interesting. The founders were really young. They had started the business right out of school. They had never had another job, basically. And it was very similar in some ways to a bunch of other much more well-capitalized competitors. It was going really well though, but I had this there were two things on my mind, which was like, you have these really experienced operators in something that like, I know is like, I know the theme really well, and I have a sort of prepared mind. And then this other company in this sort of other city that none of us had ever invested in a company in before, where they're founders who are really inexperienced, but very scrappy and like doing interesting things. And so I picked the thing that was like more familiar, and the company I picked ended up going bankrupt, and the company I didn't pick is worth a lot of money. so
like, just to push on one point, I mean, any rational investor, even if you were to present that to your LPs, they would have picked the same thing you would have picked. So what's the learning? I'm curious.
I mean, the learning is always focusing on you focused on the wrong thing. So I was very focused on the competitive piece. And I was very focused. I thought when we looked at the data, there was one element of their business that I thought was performing probably 2 times better than their nearest competitor. My theory was it was going to mean revert once they moved into different markets. It doesn't appear that happened. It appears that like that superior performance has maintained itself. So it's one of these things where you're betting kind of against the company. And usually what happens is when a set of founders finds a different model that's superior, there's usually some reason for it. And like, it's usually like, it actually usually stays that way. It doesn't revert back. And so I think I was asking the wrong set of questions around that. And then on the other side of it, I think I wasn't seeing the forest for the trees. I remember I brought the other company in to present to my team, and my team said to me, "This will never make money. Like this model is not going to work. And here's the reason why." And at that point, I was like, "Oh, yeah, I guess you're right." But I didn't see it because I was so focused on this fits something that I'm looking for. Does that make sense? It's hard to give you, I can't really get into specifics, so it's like hard. I'm trying to like generalize the businesses, but it's the confirmation bias is real. And then like not asking the right questions is like a big failure mode.
Thanks for sharing that.
Mm-hmm.
Like we have time for one more question before we break out into breakout rooms.
I've got a question. This is Ravi. I'm executive in residence at Reforge. It sounds like your due diligence process is really deep. Can you talk a little bit more about what that process is like, what type of data you get from the company, and how you go through assessing that data and making a decision based on that process?
Yeah. Well, Reforge, I mean, you guys are probably more rigorous than we are. But like at a high level, like the first principle is like cohorts are ground truth. And so you start with cohorts. And then from there, they tell some sort of story about what's happening in the business. And then you can start doing segmentation on top of those and trying to figure out where is product market fit strongest. And then you sort of have a discussion around like, can we go get more of those users? And like over time, if we do, is there a self-reinforcing loop in the product that will make it better such that that goodness spreads to the others? You know, like I don't know if you're familiar with Crossing the Chasm, the sort of the famous Gordon Moore framework, but you know, it's sort of a fallacy that companies like discreetly cross the chasm. What ends up happening in real life is you acquire a bunch of customers in a basket. Some of them are early adopters, some of them are super early adopters, some of them are laggards that for some reason they're in there. And so you actually have to sort through all these people with these different behaviors and find out where the gold is. And then over time, if you're a marketplace, for example, you'll grow your listings. So the next person who comes in is going to have a better experience, and the next person comes in is going to have a better experience than that. And so the theory is that over time, the population will start to look more like how the early adopters buy. And that's how you build a great company. And so we look for confirming evidence of that's happening. So that's at a high level what we do. What that entails is, you know, a lot of cohort analysis, growth accounting. We look at marketing. We look at segmenting on marketing channels. We are trying to correlate spend in marketing channels with CAC in those channels. We're trying to get every angle of like figuring out what are the mechanics of the business. And then once we have a theory, we build a model from the bottoms up that tries to predict what growth is going to look like and try to figure out what the key drivers of growth are. And often the cool thing about this process is actually when you work with an early stage founder on this, they actually learn stuff about their business.
That was going to be my follow-on question, whether this discovery process was net new for the founder and additive to the way in which they look at their business, or that, you know, the really good founders are looking at their business in this way already and already doing this type of work.
Well, it's usually it depends on the background of the founder. It's not usually the case that like you get founders who are like data or finance people. Like they're usually product or marketing or brand people, right? So they tend to, the good ones understand this stuff, and some of them even enjoy like spreading the numbers themselves and looking at it, but they're probably not doing it day to day because they have other things to worry about. So it actually, I think, is helpful for a lot of them to have someone engage them on this type of stuff, because it lets them, you know, it's like forest for the trees kind of thing. Like they're in the weeds every single day. Like it gives them a chance to step back and look at it at a higher level and say like, what's really working here and where should we invest more resources?